Hello and welcome to India Market Open. It's finally an end to a very painful week. 5 straight days of sell-off. We'll tell you what spooked the markets, what you should be doing, should be getting ready for a bounce back later today. But it's been tough. It's been tough. If you're a bull on the street, you are extremely nervous this morning.
You know, today, by the way, is Akshaya Tritiya, as when you buy gold and hope for prosperity. So let's hope for a tinge of that today in the markets as well. I'm celebrating it, going all bright, but
I'm not.
but yeah, so hopefully that mood will change.
Yeah, hopefully it does, and maybe that brings about. Actually, that's the chatter on the street as well, and we'll kind of establish that. But just thought at the start, I mean, we were just having this editorial discussion outside viewers about what we should do about this whole sell-off that's happened. So in some sense, what all of us are gathering from our own sources, pulling all of that together, what has spooked our markets in the last few days? Now, there is a chatter, and fairly informed chatter, of a large US-based fund selling its India positions. That's essentially the big one. It's a large position, apparently. Informed voices do suggest that the specific fund selling is almost over to the tune of 70 to 80%. There could be some more pending, maybe in the first 1.5, 2 hours of the session today. But post that kind of selling, which has been incessant over yesterday and day before yesterday, because the numbers have been close to 6,000 crores on each of those days, 7,000 crores a piece. So that kind of selling is almost coming to an end. And you know, maybe the lower voter turnout is adding to the anxiety. But from what I hear from dealing rooms, that is not the reason why that may have spooked. Because the orders that they've gotten for some of the selling is largely on the back of the positions that this fund had, which it is out in the market. Everybody knows what those positions are. Long-only funds are willing to buy those positions at lower levels. So that kind of buying has also happened, which is why probably you see 6,500 crores of selling from FIs, but then almost equal kind of buying that has happened on the DI front as well. So some of those positions are getting bought too, as we all spoke outside. But the larger point being that there is a lot of other elements that people throw in the mix that this could also possibly be the reason. But very informed voices tell us, all of us together, that this is probably the nature why the market got spooked.
We should actually pull up those DI-FI figures since we're talking about this. And since the 1st of May, over 10,000 crore rupees of FII outflows have taken place. DIIs have bought about 16,000 crores in that time. This is just figures from yesterday. And, you know, as Niraj is saying, it's a bit of a counterbalance, but of course, nearly 7,000 crores from FIIs.
The last time this happened was on the 12th of April. So it's the biggest selling we've seen in nearly a month.
Yeah. So maybe it is this one fund. I think voter turnout is part of it, but just to add, the fourth phase is on Monday. It's also a crucial one. Andhra, Telangana, the big pockets over there. And that voter turnout will also be seen very closely to see if there's a consistent trend. 3 phases, low voter turnout. Does that continue? Remember, it's just very hot season. These states get very hot, 40, 42, 43 degrees. So you're really asking a lot from voters to, you know, risk heat strokes to go and vote and exercise their right.
And weekend voting. I know a lot of people who are not going to be here in Mumbai and going on a holiday.
That's the 5th phase on the 20th. Guys, don't do that. I'll appeal to all of our viewers, don't do that. Stay back. There's a special session on Saturday also. So the NSE is
well, in
helping.
some sense, if that helps.
Also, just very quickly, when we compare those numbers to FI selling that took place yesterday, the last time this happened was on the 12th of April, which is when you had India renegotiating or working out the Mauritian tax treaty. So I don't know, while this is a case in point where it's a specific hedge fund, I think Cameron did quote that there could be some selling coming from Luxembourg too. We'll understand a little bit more on that. But talking about FIs, their net short positions are up 50% alone yesterday. So there is enormous amount of nervousness on the street, even outside a single hedge fund dumping India at this stage.
Yeah.
Okay, so FIIs are nervous, DIs are continuing to buy. The whole election question on it, till it's not done and dusted, will continue to be a talking point. But just before we get to that conversation, we're talking to Cameron Brandt today in just a few minutes from now. Let me take you through very quickly what the top global headlines were. And this is the consistent sort of pattern that we've been seeing. Domestic cues negative, global cues positive, specifically US cues. So 7th straight day of wins on Wall Street. Dow again over 300 points up. And what has been the trigger this time is the jobless data that has come in much better than what was expected. So jobless claims rose to 22,000, by 22,000 in the first week of May, is at the highest level since August. Why is the street celebrating higher jobless claims? Because that means the economy is not revving at that rate, gives the Fed enough reason to cut. So that hope of 2 rate cuts before the end of this calendar year are back on the table. That could change now from week to week. So that was key. Bonds have also been fairly soft because of all of these factors. The 10-year at 4.59. The Bank of England didn't do anything with rates, but their statements did indicate that they're ready to start cutting rates going ahead. So all of these factors have been positive. Crude prices also have been slightly inching up because positive Chinese trade data. No end to the Middle East crisis. Let's pull up Asia very quickly to see how Asia is faring. And Japanese household spending is what has at least bolstered the Nikkei. So you're seeing that about 1% up. A mixed cues on Asia overall. Implied open at our end, at least looking to a bit of a positive start. So let's hope at least for the first few minutes of a positive trade.
Yeah. Well, the implied Nifty this morning is looking okay, but it's looked okay last few days and things have just suddenly changed from the word get-go when the markets open up for trade. We have with us Cameron Rand, Director of Research of EPFR, joining in. Cameron, good morning and good evening, rather. You've tracked this data for decades together. You've been through multiple election setups in India. You know what this data looks like at the back of your hand. And hence we want to understand from you, over the last couple of weeks, or maybe after seeing a phenomenal 6 to 8 months in terms of flows for India, do you now feel like flows that are coming into India dedicated funds are slowing down or have slowed down?
The short answer is no. I have been expecting them to get a bit slower, and there was definitely a dip in the February March time period, but they've picked right back up again. I think we're looking at over 600 million into dedicated India funds this week, which is certainly well above the historic average and more in keeping with what we were seeing coming into this year.
So it's a fair assumption for me to make that the last 2 weeks have been phenomenal in terms of inflows into India?
Certainly, what I'm talking about is flows into dedicated India funds, which is sort of blunt proxy for investor sentiment towards India. It's certainly been running at stronger levels than I saw in the 2019 and 2014 elections. But in both of those cases, it was generally positive, just not to the degree I've been seeing over the past, over the past year.
Cameron, and this is ETFs or non-ETFs, because I do know outside India, it is the active fund managers that draw some more attention than passive funds. Where is the trend right now? Is it ETF, non-ETF? Because those are also a lot more expensive.
Yeah, it's a mixture of both. ETFs are certainly expanding their footprint in terms of India flows, much as they're doing in nearly every asset class. And we're seeing active managers, certainly the diversified funds, being a bit more cautious towards India than the allocations that the passive funds are buying too. But it's a hot market on both sides of the active passive divide at the moment. The one headwind from a fund perspective is that diversified global emerging markets and Asia regional funds have seen pretty relentless outflows, and every time that happens, they have to sell whatever weight they have towards India, which has been rising, to meet those redemptions.
Okay. Cameron, hi, Tamannna here. So just to put into perspective, because we're sitting here wondering why we're seeing these kind of FII outflows, and one of the theories is perhaps global investors are waiting for the election results, which will come in on June 4th in India, to revisit their India allocations. From what you're saying, it seems as if the outflows from India are incidental to other global allocations and not necessarily an India story. Is that the right way to look at it?
It is. When investors look purely at the India story, sentiment is still very strong. But a lot of the flows, certainly from a fund perspective, are tied to sort of relative allocations of diversified funds. And those are both choppier in terms of the flows, and sentiment towards India on the part of the managers isn't as bullish as we're seeing with individual investors.
Is this also in some part, how would you relate this to China now improving? The latest Chinese data, Chinese trade data points one more indicator to a resurgent China. Do you see that impacting India flows in the medium to long term?
No, certainly not right now. The narrative for China, having been relentlessly positive for so long, has flipped, and by that I mean that investors are now treating good news out of China with a great deal of skepticism. So we've actually seen pretty heavy outflows from dedicated China funds this week. I think there's quite a bit of pent-up demand to sell. So when there's an improvement in China, we've tended to see people cashing out. I think in the long run, obviously, the India-China comparison is important. But I think in some ways, India is going to get a pass for the remainder of the year, because the focus here is going to be very much on the presidential election and how whoever wins it in November approaches the US-Chinese relationship.
Cameron, let's talk about the debt markets, because while equity markets, like you indicated, have been very hot for FIs, India's inclusion in the JPM index has drawn considerable amount of funds in the last few months into Indian paper. Indian debt versus Indian equity, where do you see the momentum continuing over the next couple of months?
I think it will be more evident on the equity side, and that's largely just because there's a longer track record. People are more used to buying into Indian equity markets, know where to find the information that is useful to making those decisions. So I think there'll be something of a learning curve for Indian fixed income markets and the funds that provide access to those. So I'm not expecting a real takeoff, and certainly haven't seen it in a fund flow perspective. But I do think that India's story is long-term enough that we'll start to see a steady increase in both flows to dedicated funds and allocations in the diversified funds.
Okay, Cameron, we'll leave it at that. Thank you so much for taking the time out and being with us and giving us your thoughts. Really appreciate your time this morning. That's Cameron Brandt, and we'll continue. Great having you. Thank you. And we'll, of course, continue this conversation on the bond piece with another guest at about 8:20, because that's the other big thing. But let's focus for the next 7-8 minutes on stocks and the trade setup. Very quickly, the trade setup. I mean, there's a large two-day FI selling, which, well, as per market chatter, as we said, could be nearing a close. The markets are not in the extreme fear zone as well, but dealing rooms are talking of a bottom soon. So let's wait and watch if we form that bottom today. Maybe those references to Akshaya Tritiya, who knows? Divine intervention could help as well. A lot of stocks have fallen in this period from May too. If you just look at the markets, they've come off, but just look at the kind of falls that have come into some of these high beta names on the back of news or otherwise. Sonata, Manappuram, JSW, Sterlite Tech. The falls have been egregious from a 5-day perspective, and you never know if a bottom is formed. Some names could actually see a bit of a comeback as well. And just purely from a sector perspective, before we get to stocks, I mean, auto stocks, bullish trends yesterday in a falling market, ahead of key results today because there is Tata Motors, there is Eicher and a few others coming on numbers post-market hours today. So watch out for autos. HSBC continues to like the two-wheeler space. They say that the 10-year CAGR is still less than 2% and therefore merit to be invested in two-wheeler names as well. Let's wait and watch.
We did see TVS and Hero have a pretty good run in yesterday's day of trade. I'm going to add another quick one to that list is Jupiter Wagon. Made a record high on a day like yesterday. High beta name, but good numbers. The stock actually did a pretty good somersault in trade, but finally went home with a gain of 3% off the day's high point, but relative outperform in terms of what we saw. Also, a quick check on the other reactions that we are expecting in today's day of trade. You've had BPCL. It's been a little difficult for these OMCs in the last couple of months, to say the least, with in fact, they've been dealing with higher crude prices. Keeping that as the backdrop, operationally, the numbers haven't looked too bad, even though GRMs have seen a decline, which was largely on expected lines. Remember, 15th of March also saw a price cut, so limited impact on earnings, but nevertheless, that was visible too. In terms of what we had, revenues came in about 1.5% higher. EBITDA came in about 47% higher. So it's a big jump coming in on operational performance for BPCL. Net profit was also up 24%. What was not up was GRMs, and that was very obviously under pressure. The BPCL has also done a bonus issue in the ratio 1:1. The record date for that was it's been set for 22nd of June. The stock was beaten out of color in yesterday's trade, was down 5%. You also had higher crude prices. That was the overwhelming sentiment for these OMCs. But apart from that, keeping that in mind, they've operationally actually not done too badly in context of everything that's going on for the sector. Well, apart from that, Abbott India, their revenues were up 7%, so a good number in terms of what the top line looked like. EBITDA also came in 18% higher, 330 crores. Margins have seen an improvement, and I think that's what the markets would like to see. The stock, like we can see, was lower, but most counters, remember, were lower in yesterday's day of trade. Net profit was up 25% to come in at 287 crores. They've also recommended a final dividend. So Abbott is one you want to watch out for. Good earnings, good margins, top line as well, doing a beat in terms of what the expectation was. Mahanagar Gas, not such a good set of numbers. Revenues were up, but they've taken a hit on margins. Their profits were also down, and EBITDA was down. So while on the top line, the number looks pretty decent and healthy, it's everything else below that that is a little disappointing. You will see the stock come under some pressure. Remember, we've not had too many brokerage reports commenting on this just yet, but it's only a matter of a few minutes or in the next couple of hours where this will start flowing in, and you will see what they made of this earnings and the reaction of that on the stock. The count, of course, was low by 3.5%. Some more selling cannot be ruled out.
Just wanted to, of course, there are several stocks to talk about, but just wanted to put the focus on Tata Motors for a second, because numbers are expected today. I think of the entire deluge and bloodbath yesterday, auto stocks were relatively unscathed. Even Tata Motors was up about 2%. Apart from the numbers coming in, this news report this morning that they're going to spin off their vehicle financing unit and merge it with Tata Capital might see some buoyancy there. So look out for a Tata Motors. Look out for a Zomato, just simply because, we've been talking about Akshaya Tritiya, etc. A Blinkit, an Instamart, a Zepto are all delivering even gold coins within 10 minutes today. So the kind of spends that you might see coming there will go up because you're just making it more convenient. I would watch out for that. Relaxo Footwear is the one in terms of numbers that I would highlight. Poor numbers overall. Revenues were down at 2.3% at 747 crores. Net profits are down at 3% as well. So the top and bottom line not looking great. Margins okay. Slight uptick to 16.1% versus 15.4%. This is all year on year. And EBITDA up marginally at 2.1%. So you're going to see a spot of weakness there. A couple of other news-related ones, but I'll circle back to them.
Okay, just very quickly, the top three on my radar, Intellect Design Arena, also because lower than Bloomberg estimates, and Avendus Spark has given a sell call as well. Revenues were down 3.27% at 614, but below estimates of 631. EBIT margin, though largely in line or maybe marginally higher, but the PAT number much lower than the Bloomberg estimate number of 90.77 crores. The number was 73. and therefore very likely that Intellect Design, also because brokerages have not sounded too constructive, might show a bit of a negative reaction today. VST Tillers most certainly should show a negative reaction today. Revenues were down 15%, margins down 234 basis points. On that base, that's a large number, and PAT down 13% at 34 crores, so that one could be weak today. And Shyam Metallics could be an interesting one because stainless steel sales and aluminum foil sales for April are up very, very strongly for Shyam. What is down is pellet sales, but that's just about 9% of revenue. So pellet sales are down 62%, but that's just 9% of revenue. And therefore, Shyam could, it's sucked a little bit in recent times, could actually see a bit of a positive move today on the back of the April data. So watch out for this one.
Just a couple of more stocks to watch out for. Brigade, I would say they've signed an agreement for a prime land parcel for a residential project in Bengaluru. I mean, these news pieces just keep coming. I don't know how much of Bangalore is left to develop, but there you have. Lots apparently. Development, now they'll go into redevelopment perhaps, like Bombay is the redevelopment story. 660 crores is the estimated gross development value. 197, which has refuted reports. Again, there were news reports of lending partners invoking loan guarantees. That stock was up 5% yesterday, even on a report that perhaps they're going into ride hailing. I don't know, they've not said anything specific on that, but you have to fix one business before you try and get into another very crowded space. So they've said that we act as a distributor of loans and we don't provide a first loss default guarantee. Essentially, if you were taking a loan through their portal, did they have to be the guarantor if whoever was the borrower didn't pay is the question. But that stock was up 5% after several days of drubbing, one to watch. And just one more perhaps is a Vijay Diagnostics. There's a Nuvama note out which has set a target price of 910 rupees, which is about 25% upside. They're impressed with their Q4 numbers, robust volume growth, impressive EBITDA margins, and expansion will pay off. They're poised to gain in Pune and Kolkata. So where it's quite dismal otherwise, already an 8% run up, but perhaps more steam left.
Yeah. There's one quick one I want to mention, only because it was such a popular one that we had, and that's Gopal Snacks. They reported numbers which were not very impressive actually, so this may see some pressure. Again, the last time they did the reporting, the stock had lower circuit of 5%, cannot be ruled out this morning in trade. They've seen profits decline about 4% to 26 crores, while revenues have seen an increase, but in terms of margins and profitability, there's been a sheer decline in terms of earnings. So this was this had a little bit of a retail touch where a lot of the common man was very excited about Gopal Snacks, but yeah, numbers not reflecting in that.
Yeah. And Asian Paints is the other one, wherein the numbers, post numbers, the stock was down 4% yesterday. Now, post that, most brokerages are not too convinced even now. So Jefferies, for example, has a conviction underperform on Asian Paints with a target price of 2,200 versus 2,500 earlier. They say Q4 is an all-round miss as revenues declined for the first time in recent past. The volume grew in double digits, which is a positive, but the margin decline as the advertising and promotional spends and staff costs ramp up to defend mindshare and improve service levels. So that's a concern there, and they say the concern is also on the rise in competition, which creates uncertainty. So do watch out for Asian Paints. If they maybe, just maybe, there is more downside. Morgan Stanley too has an underperform rating on this one. And some other brokerage calls include M&M Financial, which has been cut to a sell at Goldman. The price target is 233. Sula Vineyards, which has been cut to reduce at CLSA, price target 515. And Intellect Design, as I said, cut to a sell at Avendus Spark, price target of 830. So watch out for each of these. Okay, let's speak about this reiteration, so to say, about the JP Morgan bond index and what it could mean, because debt markets too, as Samina has been saying consistently, have had a bit of, inflows in fits and starts, if you will, or a bit of an ebbing and flowing. Ajay Manglunia, who is Managing Director and Head of Investment Grade Group at JM Financial, joins us right now with his perspective on how should one read into this reiteration about the JP Morgan bond index inclusion being on track and what it could mean for debt flows, amongst other things. Ajay, great having you. Good morning. Thanks so much for joining. And I hope I got your second name pronunciation correctly, Ajay. But I did. Okay, thank you. So, Ajay, how do you read into what's happening in the debt markets currently on the flows side and the fact that there's just so much of to and fro when it comes to this JP Morgan bond index inclusion as well? The timing, that is.
Yeah, I mean, the fact is that the market was awaiting since a very long time for such inclusions. And you might have seen that since last 4-5 years, the India debt market was pretty ignored by foreign investors. Maybe for a couple of reasons, they might be looking at some control on the fiscal and some bit of stability on the government side. And when all of those things are there in place, JP Morgan was quick to kind of get this opportunity and kind of include it. Earlier, they were struggling about getting some tax concessions and all of those things, which government was very reluctant, and they made it very clear that we are not here to invite foreign capital in the debt on tax incentives. And without tax incentives, I think foreign investors are looking at that this is a wonderful opportunity, though there may not be too much of a spread as of now, but in the real term, with a 4% kind of inflation anchoring aspiration, and which is coming true, 7.5% kind of yields are definitely for the macros like India and all of the other attractive. So I think JP Morgan, who had about $200+ billion worth of investments in this particular indices, who are the investors taking this indices. The weightage is about 10%, so we can estimate about, say, $20 to $25 billion worth of inflows likely to be there in India. And this will not only help kind of anchoring the yields and pushing them down, in a nutshell, making Government of India to borrow cheaper in the coming time. This is just an initiation for one indices trading entity to include. I think there are others, including Bloomberg and others evaluating. If all of those happens, definitely the yields in the coming years, we can see a lot improvement.
Ajay, good point. Over the medium to long term, this is definitely India positive, even for the private credit market, which has seen a pretty sharp uptick. So good for India Inc. as well. But let's talk the next couple of months. I know that a lot of people were sitting on duration funds, hoping that a rate cut would come our way. Now, with the derailed rate cut in the US, there is no way India can go out and cut rates before the US does so. While these flows are significant and they've moved the yield curve to some extent, do you think that over the next couple of months, do you think post June 28th or to the run-up to June 28th, flows will increase and that will impact yields in the near term? I ask you this because the last 1 month has actually seen outflows out of the Indian bond markets.
So, Samina, if we see carefully after the news of global bond indices inclusion, in the FAR bonds, where foreign investors can assess and freely buy these papers, we have seen an inflow of $8 billion. There's been a little bit of outflow with kind of yields moving up in the US market. But if you look at Indian market, the yields have not moved. Rather, they've been kind of, after moving in directionally with the US market, have tapered down back. So I would say 710, 720 is kind of a range since a long time. And I don't see yields moving drastically beyond 720, 725 levels. So they are more or less likely to get anchored here. Apart from the rate cut, the larger story is basically in the coming times, if the inflows and the demand for Indian papers are likely to be significant. We have anyway decoupled in terms of yield trajectory from US or the western part of the world. And you might have seen with even 70, 80 basis points yield movements in western part of the world, Indian market has not been moving in the same proportionate, but directionally, yes, it's 1-2 basis points or maximum a couple of points, then that's it. The major point which we need to see that private credit will also get influenced, because the thing is that when the global investors are taking the yields in the sovereign down, the spreads on the private credit and corporate bond will become attractive. And the next attention, once the global investors looking at GSEC, the next attention they can probably put it on the credit-worthy a couple of infra and sovereign and AAA and quasi-sovereign papers. So we see this flow not getting restricted only for the sovereign for the time being, but this will trickle down to as low as AA rated credits, and we have seen that for 2017-18.
Right. So Ajay, just in terms of advice, if you had invested in debt mutual funds, you know, maybe mid last year, early last year, end of last year as well, I wouldn't rule that out. You would be expecting that you'd make an M2M gain. Of course, one way is to hold it for 3 years for tax purposes, which is to maturity. Alternatively, a lot of traders and investors got in hoping that the M2M would yield enough for them to justify solid returns. I mean, there was also talk about double-digit returns on those debt funds.
I'll explain you.
At this stage, I understand. But at this stage, what should those investors do? Should they exit these positions? Because this is not going to happen in the next 1 year from the look of it. And second, for a fresh investor looking to enter the debt mutual fund space in order to create and gain that alpha from the debt funds, is that recommended? Are you telling your clients to go out and, you know, invest into debt funds at this stage, keeping everything else in mind?
So debt funds obviously can't give the equity-like returns for sure, but they give a lot of stability. Equity markets may be a little more volatile, but in the debt side, the markets are a little less volatile, so we can't compare both. But my sense is that if somebody invests today and he takes the duration, and that depends on the respective fund manager. So investors would kind of have some patience and put in money in the funds which have a larger duration. So rate cut might not be a only requirement for markets to move in terms of yields down and have a double-digit returns. What I say that if somebody is getting a 7.5% kind of a carry on its investment and the yields move down over the next 2 years, I'm not talking about a year, but if yields move down by say a couple of basis points, maybe even 50 basis points from here, in the duration fund, you can easily make 3-4% extra capital gain. And that will translate to double-digit kind of a return. So expectations of having a double-digit kind of return over a slightly medium to longer tenor, longer period, is absolutely possible, and that's visible.
Okay, so that's great to hear that view still remains. A 50 bips rate cut or movement on the yield curve could generate 3 to 4% alpha on your paper. So if you're at 7.5, you add another 4% to that, you're almost close to 11%, which justifies investing into debt markets. But remember, debt usually is an instrument which is a safe instrument, and that's the stability part of the portfolio. It's equity that's supposed to do the sprinting for you in that sense. But thank you, Ajay. It's always good to get perspective on how the dynamics between equity and debt work out and impact an investor's portfolio. Worth noting is that our inclusion will also lower the private credit costs. So you've also seen a big jump, over 50% in FY23 itself, where private credit was being raised by Indian corporates. So if cost of funding does come down, it is going to have a positive impact on the earnings of India Inc., which would then, of course, also impact the stock market performance. So lots of interconnected pieces there. We'll take a break. We'll come back. Whether or not the selling is going to abate is what we'd like to find out and understand from the F&O picture. So stay tuned for more on the other side.
Welcome back. This is India Market Open. Well, we are in a treacherous territory. We are looking at India Volatility Index spike, even as benchmark indices are now starting to look substantially weak. Let's take a look at how things are panning out as far as, well, futures and options are concerned. At the moment, when it comes to the benchmark, the Nifty has lost out on the psychological 22,000 mark. We are looking at a whopping 14% increase in the Nifty futures open interest towards what it does look like fresh shorts into the system at the moment. And the Bank Nifty, once again, losing out on 48,000. In fact, it closed below 47,500, declining by around 1%, adding 9% in the futures open interest towards fresh shorts there as well. What about the options market? Perhaps on expected lines, a lot of the activity was concentrated on selling calls yesterday. As you can see on the green bars, there was largely and essentially a call writing and not as much comparative put writing coming through. When that comes up with the overall open interest distribution picture, from a few days ago of 23,000 call as the one with the maximum open interest, it has come off gradually to 22,800, 22,500, and now we have max OI in 22,500, but a considerable amount and nearly equal amount of writing around the 22,300 mark, which also means that there could be a substantial amount of resistance around there. 22,000, I reckon, will be a little bit of a pivot now at the moment. And of course, on the lower end, all the put writing activity now starts to shift towards 21,500. So the whole range has shifted downwards over the course of the last 3 days. Well, let's talk about stocks then. And once again, a lot of them essentially reacting to earnings. Muthoot Finance down along with Asian Paints, looking at shorts. Of course, Voltas and Berger Paints, not very different. In terms of stocks which saw unwinding, again, a lot of long unwinding coming through. So Piramal Enterprises, UBL, Navin Fluorine, along with Deepak Nitrite, all of them in focus on account of the same. But let's get in an expert opinion and see how things are at the moment, what their view is of the markets and what they're doing. We have Aditya Arora of Analytic Research who's joining us on the show. Aditya, morning. Thank you so much for joining in. Your view on the Nifty and the Bank Nifty, what are you doing with these indices?
Very good morning, Agam, and warm wishes of Akshay Tritiya to everyone. Hope Mahalakshmi blesses with a good upside in the market. So the other side of the story is that markets have sold off significantly in last many days, but the other side of the story is that markets are also oversold. So and the global context is good. Global markets are doing well. So I think markets don't look so bad. One shouldn't short the market at these levels, but look for buying opportunity at current levels or little bit downside, keeping one standard deviation as some margin of safety. So currently Nifty is trading at 21,957 and in futures about 22,050. So one should keep margin of about 200 points and accumulate the index. And I think market could swing on the upside with target of about 300 to 500 points would be the target. So this isn't a breakout trade, but mean reversion trade. So possibly it couldn't, it may not be a V-shaped recovery, but it could be a U-shaped recovery with little bit of consolidation and then upside. So my bias is neutral to bullish on the market. I would look to accumulate markets on the dips. So I would be a buyer.
Accumulate when it comes to the key benchmarks at the moment. Aditya does feel that at least the key benchmarks are oversold and there could potentially be some amount of mean reversion in the near term. But Aditya, let's talk about stocks then, and I believe you have two metal counters on the radar today.
Correct. I think one thing really stands out is commodity trade. Whatsoever happens in the market, the international commodity market is really buzzing. Yesterday, copper was up about 1%, silver was plus 3%, gold was plus 1%. So I think metal trade really looks good, and as a high sensitive, sector, it swings on both the sides with high beta moves. So right now we have reached the lower band of the range. So at this point, I think it's a buy. So I have a strategy in Hindalco. So Hindalco's 620 call could be bought. Current market price is 21.95. 660 call could be sold. Current market price is 7.95. Maximum loss is 19,600. Maximum profit is 36,400. And second one is Jindal Steel. 930 call could be bought at 34. 970 call could be sold at 18.55. Maximum loss potential is 9656. Maximum profit potential is 15,344. One disclaimer: I've recommended metal stocks to my clients, so one must do a cross check and do their own analysis before entering a trade. And lastly, I'm very bullish on the metal sector. I think this space can really outperform the market. If you're looking to be bull at this point, then one must keep metal stocks on radar.
Right, so two very simple, straightforward, debit spreads when it comes to these two metal counters. Aditya, thank you for joining us and taking us through your views on the markets and also helping us with a couple of trading ideas. We'll continue to keep a track on that one, certainly when it comes to the metal space. With that, it's over to you, Niraj.
Thanks a lot for that, Agam. So that's the election trade plus some option strategies for you to ponder over. The other strategy to ponder over is what to do with the PSU banks, because while the SBI numbers had a bit of a one-off and that may have disappointed some quarters of the street a little bit, it's important to get a perspective from somebody who tracks the space very closely. Shantanu Chakrabarti, India analyst, BFSI at BNP Paribas, joins in. SBI and maybe to an extent PNB is just the peg, but let's just try and figure out what he thinks about what's happening in that space. Shantanu, great having you. Thanks for taking the time out. This is Niraj here, good morning. And I'll start off with the most obvious question, which is what did you make of SBI numbers? I don't know if you have coverage on PNB, but those numbers also came out yesterday. So PSU banks at large, are they holding out well, or is there an issue out there?
Thanks for having me, Niraj. Yes, the SBI numbers had a one-off. And both at the other income level as well as a slightly lower number on operating costs, which has flattered the overall numbers a little bit. But forget all that. Just keep in mind that even at NII level, there was a small beat. So one very interesting thing which has come through for quite a few PSU banks and for a few large private banks as well this quarter is that, Niraj, the cost of funds seem to have kind of either peaked or peaking in a quarter for a lot of banks. So which means that, say, for example, we saw in the case of Axis, we also saw in the case of SBI that there was sequentially a small but an increase in margins, which has been one of the key worries going forward since the credit cycle and everything else seems to be in control for now. So overall, I would still say these are strong numbers for SBI. The headlines which came out during the day might have flattered those numbers a little bit more than what they were once you went into the internals. But nevertheless, the internals remain quite impressive. And it's not as if stock has still run away to some absurd valuations. So we see no worries out there. SBI overall, in our picks, remains the fourth place after HDFC, ICICI and Axis. And overall for the PSU space, all I'll say, Niraj, is that, yes, you're right. We don't have coverage on PNB. But one thing that investors would do well to keep in mind is to look at the relative valuations within the space. It would have to be a very, courageous when who would argue that there's another PSU bank out there with a stronger business model than SBI. And yet, when I look at valuations, SBI on my own numbers, and let's say what the consensus numbers are for the rest of the PSU banks, the valuation differences have really come close together. This is especially true once you build in the subsidiary valuation of SBI. So, there's a clear message in those relative valuation numbers for investors at large.
The question therefore would be that, okay, some people are arguing that some of the PSU banks, and we know PSU banks have done very well since the COVID lows, right? The question is, aside of the top tier private banks, if people are invested in the second tier private banks, are some PSU banks or maybe just SBI a better bet for people who don't have PSU banking exposure? Should they move out of the second tier private banks and log into a PSU bank like SBI and others, or only SBI, or no, not do that trade?
Right. So, one of our concerns with the overall mid-sized private bank, most small finance bank cases, and the only exception we have really had to this has been AU Bank. It has been one of slight concerns on the business model. So one thing that seems to be playing out very clearly is that the business models of a lot of small banks like CUBK, which we cover, seems to be under pressure on both the asset side and the liability side. The cases where the liability was the primary moat, it seems to be shallowing out over time. And the asset differentiation of the banks, for example, CUBK itself, doesn't seem to be as strong as that of an NDFC, that it could defend itself through a lower cost player's attack. So you see, a lot of migration of customers from these, mid-sized kind of banks towards the larger private banks, and in some cases even to larger PSUs. So, the business model in itself, the profit model, is between a rock and a hard place, in my opinion. So, while large private banks are our primary play, and that's where we think the compounding story is the strongest, and it comes to you today at a valuation which is below median, with fundamentals which are probably the best in 2 decades. There's also, for an investor who's looking for a little bit more beta, they could look at either, the PSU names, including SBI, which is a 4th in our pecking order, so fairly high. And, the compounding stories could be added either through larger private banks or through, say, some insurance names. For example, we really like SBI Life. We think that barbell approach is a little better than trying to find beta in some of the mid-cap banking names.
Shantanu, I take your point where you said you would rather play the sector through private sector banks. A few months ago, you were very clear that your pick or your preferred bet here was ICICI Bank over HDFC Bank. Of course, post what you've seen on the earnings as well, the reaction on ICICI Bank has been much better again. If I had to ask you right now, and I feel like now could be a good time to accumulate those banks, post the earnings, a little bit of selling that's happened as well, would ICICI Bank still be your top pick, or have you changed your bias?
Right. So, Samina, just to clarify something out there, it's not that we had ICICI Bank as the top pick. I wish I had, because, in hindsight, it would appear smarter sitting in front of you today. But HDFC Bank was our top pick. What we had said about ICICI, which was our second pick, is that the compounding that you have available on ICICI is in some sense the most drama-free as far as the Indian banking sector is concerned. It has taken that old positioning that HDFC used to have, a very predictable and quite rewarding compounding, right? So, that's how we see ICICI positioned. And on ICICI, one thing we have to make very clear, ICICI has the second lowest cost of funds within the industry, surpassed only by Kotak. And once you load operating costs onto the cost of funds, you basically realize that ICICI is working with the cheapest raw material in the sector. Samina, the luxury of working with cheapest raw material in large size banking, when you have distribution scale, means that you don't have to find ways to make money. Competitors have to find ways to catch up with you. And that luxury of having to do less is invaluable in a business where you actually put out money and tend to make money of the last few EMIs. The strength of this, maintaining this hygiene over a longer period of time, it cannot be overstated. So from that point of view, I think ICICI is very well positioned. Why do we have HDFC still ahead of ICICI? Simple reason that once we acknowledge that HDFC is now a higher cost of fund bank, we also must acknowledge that it is now a lower cost to asset bank than it used to be. ROEs have near bottomed out, and we see a clear path to 17% ROE, which was their ROE previous to their merger. So if the valuations get to anywhere near where they were, we have a large outsized re-rating opportunity also waiting out there. The re-rating opportunity in something like ICICI cannot be as dramatic by definition, since given the predictable earnings that they have been delivering and the crowd favorite they're extending to become. But the path on that HDFC return has proved to be a little more rocky, right? I mean, there are surprises along the way. People are tracking what's happening to liabilities on almost a monthly basis, and there will be ups and downs, surely, on both positive and negative surprises. We just think that the cumulative re-rating opportunity is larger, and we are happy to, grin and bear the pain along the way.
Shantanu, I'm going to do a Hail Mary here and see if you actually track the space. And I want to talk about non-banking, right? And I want to talk about everything that's capital market. And it seems like all the valuation, the alpha play really is coming from the private banking, wealth creation segment that every bank and non-banking player is now going after. Have you been tracking that closely? I mean, the likes of an IFL, 360, Nuvama, Edelweiss, Anand Rathi. Is this a space you track? Are you constructive if you track them? What is your reading of the situation?
Right. So, without getting into stock-specific details, I mean, I am yet to come across a lot of people in India who are negative on the prospects of the Indian capital markets over the longer term. So that they are riding a structural tailwind, all companies within the sector, is very clear. So, there are two aspects to this. Therefore, on all capital market derived plays, you have to figure out what are the valuations they are trading on, and given what their profit model is related to the capital markets, are there any risks to it from either a regulatory or a competition perspective? For example, we have seen large swings for AMCs in terms of how much money they can make on their AUM, on their equity AUM, purely based on how the distribution architecture has changed given regulatory interventions over time. So those things also have to be factored in. And, there should be a certain margin of safety in valuations in factoring in how those numbers work. The more derivative businesses like wealth, etc., I think it would pay for investors to pay a little more attention to how much of the money made is actually from capital markets, and are there other elements within those respective businesses which are also significant sources of profits. And if there are so, then those businesses need their individual separate risk assessment and valuation.
Shantanu, hi, Tamannna here. So,
hi, Tamannna.
I'm just wondering how big a risk is regulatory action right now in the space, because that seems to be, giving sleepless nights to everyone who's a banker, an NBFC head, and anyone who tracks the space as well. What do you make of this, and does this make you a little jittery? How do you then classify which companies or which banks are relatively safer?
Right. So, I mean, RBI has very clearly laid down the law. It's made it very clear that as far as regulations on customer onboarding, basic KYC, AML risks, etc. are concerned, there are zero holy cows, irrespective of how prominent the institution may be and how celebrated it may be within the broader financial ecosystem. There is, of course, any large intervention from the regulator always carries within it some risk of disruption. But long term, I don't see this as a negative. I think India has gone through an absolute transformation, especially accelerated at the point of COVID, in terms of digital onboarding. If regulatory intent forces people to catch up in terms of due diligence, and onboarding P&Qs for new business going forward, then it makes the entire digital architecture build up over the next decade or more, that much more robust. So yes, the news flow does not help, especially if you're owner of the stock. But I think long term, it's going to be, a positive for the sector. Also, we have to differentiate between the natures of news flow which have come in. The unfortunate reality is, in some sense, if you are a player who has interconnections within the system in terms of reciprocal liabilities, etc., with the rest of the banking system, I think that acts as a natural hedge against against regulatory intervention to the point of destabilization. So you'll see that those with larger balance sheets have got penalized, but their penalties mostly relate to their respective P&Ls. While we have had other cases where the impact went beyond the P&L and challenged the balance sheet and business model, which is a very different kettle of fish.
So if I were to, ask you about some of the recent players which have been hauled up one way or the other, whether it's an HDFC, a Kotak Mahindra Bank, Bank of Baroda has just, seen a reversal of its restrictions, or a 197, an ILFS. Which ones do you think will bounce back and which ones will have a bit of trouble?
Right. So, HDFC, for example, we saw, the embargo go away. Yeah. We just saw Bajaj Finance, the embargo on the 2 products being re-signed. Even when this Kotak implication came through, we pretty much downgraded it overnight. It's not that we are a neutral. Before that, we had our concerns about low compounding and still, lingering high valuations. So we were neutral, especially given the upsides I had for some of the larger private banks. I downgraded on purely on the concern of rising risk premiums in the minds of investors, not because there was a large compounding impact. So one thing we have to keep in mind is that while digital onboarding forms a fairly large proportion of the new customers that you bring onto the fold, given the demographics, the age demographics of customers you're bringing in through a digital-only channel, and the current mix of customers, these new customers today are not bringing in a large part of your liability or asset business. They're larger in numbers than in terms of weight. So the ticket sizes are smaller. So when you look at the compounding impact of a 6, 9, 12-month interregnum, you'll basically realize that it's not as if the earnings shifts by a very material amount. It is more the perception around the systems and processes of the banks and how investors look at those, and what comfort they derive from business like banking, where these processes are absolutely existentially crucial for stability, is where the perception battle lies. Not compounding, not in earnings.
Fair enough. I don't know, perhaps there's also a bit of question about how did, the managements of these very storied and reputed banks allow things to get to this level. But nevertheless, always great speaking with you, Shantanu. Thank you so much for joining us today. That was the perspective on the BFSI space. Time for a very short break. We'll be right back with the pre-open. It's going to be an action-packed morning. Stay tuned.
Back with India Market Open right here on NDTV Profit. We are about 45 seconds away from the market open. Let's just get the implied open very quickly before we get to Amardev Singh and Avinash Gorakhshekar. About 57 odd points in the green. So actually, let's see if we bottom out early morning or do we do it after maybe a few hours of trade. Amar, good morning. Thanks for joining in. What do you make of the market action? We might have a bit of a green at open. Would you use that to build longs, or is this a sell on rise market?
Yeah, very good morning, and thank you for having me on the show. So if we look at the intensity of the fall, and also if you look at India VIX, so these are very, I would say, clearly telling that there could be further selling as well, because most of the large caps, I would say the heavyweights, we are seeing some sort of, I would say, consolidation and some sort of weakness in some of the stocks. But the good point is that Nifty is approaching a very crucial support zone. So if we go back and see, Nifty used to bounce back from almost 21,700, 21,800 levels. So that was a zone of major and crucial support which Nifty has respected and held on to. And if we look at the recent low, that is yesterday's low, that was around 21,932. But I would say that if I look at the short-term trend, that is definitely negative. If I look at the intermediate term trend, that is more or less consolidating with a slight negative bias. And also, if you look at the derivatives data, we see that there's been short build-up happening with significant OI over the last couple of days and yesterday in particular. But I would say that we'll have to watch out for the levels. So 21,600, 700, that's a very crucial zone of support for Nifty. And the short-term trend remaining bearish. So if there is a bounce back, there's a high possibility of we would witness some fresh selling coming into the markets. Till the time we don't see a cool off in India VIX, and yesterday's high of India VIX is also going to be a very important level to watch out for. So I would say that one needs to be slightly cautious. The short-term trend definitely remaining bearish. We are moving close to support level, so there could be a bounce back. Whether this bounce back holds is something we'll have to watch out for.
Okay. And Avinash, just before we come to you, Ahmad, let's just get your stock ideas done as well. What is it that you're recommending?
Yeah, I would say one stock one can definitely look at is Supreme Industries. This is one stock which has, I would say, consolidated. It was in for consolidation for a very long time, and then we saw the stock breakout. Currently, it's around 5,400 odd levels. So any pullback in this stock is a buying opportunity with an upside target of 5,600, and crucial support for the stock is seen around the 5,200 level. So this is one stock one can look at, and the other stock to look at is Godrej Consumer Products. So this is again one stock which was in for consolidation, has breached crucial zone of resistance, and also what we are seeing is that volumes have been significantly higher over the last few trading sessions, but only on a pullback. So somewhere around 1280, 1300, that's a good level for entry, because the stop loss needs to be below 1250 levels. And on the upside, the target is around 1430. So this is the second stock one can look at.
Good morning. Thanks for joining in. Do you feel like there could be a pullback around the corner? The last few days have been pretty rough for the street. Technically, of course, we look ripe for a little bit of a pullback on the street. But fundamentally, do you feel like there's enough reason to go out and buy?
Is this question for me, Samira?
Yes, Avinash.
So basically, see, I think you're going to see a very volatile market. I think markets are now going to be dictated purely by electoral trends. And I think my sense is that we could see a lot of volatility considering the kind of VIX we saw yesterday. Typically, in the month just ahead of the election result, I would be a little cautious in entering any stock in a very relatively big way. But I think if we at all get some further downside, then I think one could start nimbling into the large cap names, some names like ICICI Bank, Axis Bank, or typically even the PSU banks like typically a Bank of Baroda. My sense is that, these offer a lot of long-term value. And I think once the election result is out, we should definitely see a strong bounce. But it all depends on the margin of victory. I think the markets are now discounting the number of 400. Possibly a figure of 350 to 370 if it does come in. I think the markets could definitely see a decent amount of re-rating. So I think, this is the time where one has to take a calculated risk and actually bet on the large caps. We would stay away from the mid caps.
Right. Just a quick look at the first cut of pre-open rates coming in, and of course with the caveat that these will settle. What's catching my eye? BPCL about 6% up, Shriram Finance doing well, SBI, Coal India, Adani Ports, Bajaj Finance, all of these on the winning side. Let me just start with BPCL. Avinash, your take on the numbers, the results that came in. The bonus issue was something that had the stock, buoyant through a pretty rough week. Would you say that uptrend continues for you as far as the BPCL is concerned?
No, I think, Tamanna, if you look at the BPCL numbers, there has been a big exceptional gain of almost 1,600 to 1,700 crores. So if you strip it off, I think numbers have been largely in line, but I think not very strong in that sense. The bonus issue is a surprise because, their comparable peer HPCL has given a 1:2 bonus. So I think the bonus has been more lucrative. But I think going forward, hopefully, if crude prices remain soft, considering that now the Iraq-Israel issue is more or less cooled off, I would not be surprised that in the coming year, GRMs could improve. And I think you're seeing a lot of good demand from, sectors like automotive, aviation. So I think to that extent, I think definitely it looks a decent bet if one were to look at the next 6 to 12 months. But yes, I think numbers were not very impressive. I think in line, and largely because of the exceptional gain, you saw a big jump in the profit.
Amar, what about on the charts, BPCL and HPCL?
So if you look at HPCL, so we are seeing some sort of consolidation there. And if I look at the stock, it is witnessing some sort of profit booking as well. And because on the weekly charts, it clearly shows that a top is being formed for this particular stock. And on the downside, the stock has got good support coming around the 470, 480 levels. Whereas intermediate term trend, I would say, is more or less consolidation. Talking about the other stock which you mentioned, BPCL, if I look at BPCL, there is Bharat Petroleum. It is having a similar structure as compared to HPCL. And again, it is also witnessing some sort of consolidation. So I would say that it's more of a trendless phase for both of these stocks. BPCL has got good support coming around the 550, 560 zone, whereas on the upside seems to be capped around the 630 zone. So it's more of a consolidation for both of these stocks.
So that's BPHP for you, and interesting moves there. The other one is Asian Paints, and Jefferies has come out with a note saying that they believe that this is a conviction underperform, and after the 4.5% gash yesterday, is there more in store is the question. Now, Avinash, would you be a buyer at the dips, or do you believe that there could be pain ahead for an Asian Paints investor?
I think my sense is, Niraj, it's better to wait for a couple of quarters because competition in the paint market has intensified. In fact, now there are 2 or 3 new players. And looking at the recent entrant, that is Grasim, I think my sense is that, some sort of price damage in terms of margins has already started getting realized on Asian Paints numbers. But I think you will probably see a bigger impact in the first half of financial year FY 24-25. So I won't be surprised that the stock could possibly continue to remain under pressure because clearly the markets are now looking at the fact that in what way is Asian Paints going to defend its market share and obviously preserve its margins. So on one side, crude prices have softened, but I think on the other hand, competition has intensified. So I think at best it can be a hold. We would not suggest a fresh buy at the current levels.
Tata Motors had a pretty decent day yesterday. Numbers are expected today. Technically, this was looking good, and it seems like the fundamental news trigger will be the earnings. But this morning at 1,037, would you be brave enough to go long on Tata Motors ahead of earnings?
Yeah, I think, if you ask me on Tata Motors, I think the company has now decided to separate both the automotive commercial vehicle and the passenger car business. This remains the key trigger. And I think as far as the JLR business is concerned, Samira, I think we are going to see a better traction on both the volumes as well as the margins. In fact, the company has maintained that it should obviously generate free cash flow, which is a very important variable for them. And going forward, I think the demerger trigger is going to play out. In fact, yesterday, there was some news saying that even the NBFC business is now going to be transferred to Tata Capital. So that also obviously would mean that the company gets more focused on its business entities. So at best, I think we'll prefer to wait for the numbers. But yes, at around 1,000 or just below 1,000, one could definitely look at accumulating it. We feel automotive is one sector which should do remarkably well in FY24.
Okay. Well, the pre-open rates have certainly settled, and if just a quick check before we get to Harsh, my colleague, for the brokerage calls. BPCL should come up on your screen. It was showing some exaggerated moves at the pre-open session, still 4% higher. So the dividend plus bonus plus the brokerage calls seem to be working for Bharat Petroleum. So that's a stock that you certainly want to keep in mind. And just watch the Nifty as well. I think just after the kind of cuts that we've seen in the recent past, it'll be very interesting to see how the index behaves in the first 1 hour of trade. But brokerage is in focus. Harsh Johnson with the top 1 or 2 brokerage calls this morning. Morning, Harsh.
Good morning, Niraj. First off, we're looking at Asian Paints. Jeffries has a bearish stance on that one. 2200 being the target price. They've reduced the target price from 2500. They believe the earnings overall from revenue all the way to PAT was a miss. On the revenue front, they believe volumes, especially on the rural side, were a bit of a disappointment. And of course, with increased competition, advertising and promotion spends were also higher, which they believe as a strategy is good. The volume focused strategy is good, but just the fact that there is going to be intense competition going forward makes them cautious, and therefore what they've done is they've reduced their target multiple on Asian Paints from 50 times to 40 times, and therefore the target price has also come off, and from the current market price levels, it's looking sharply lower. It was just about 10% lower versus current market price earlier. It's now nearly 30% lower. So nearly, my apologies, 20% lower, and therefore clearly bearish on that one. The other one is HSBC on Tata Power. Again, they've downgraded Tata Power, but they've hiked the target price there. 31% downside even now. They believe execution risks beyond what Tata Power is in control of is where the key challenge lies currently. They believe the numbers were softer and will continue to remain softer on the back of that execution, especially slower execution on pump storage projects as well as government reforms. Those are the key catalysts according to them. And also coal prices, they believe, will continue to remain benign. Of course, some upside risks on the back of higher coal prices and execution, but outside of that, they believe that Tata Power is currently a reduced target price 300 rupees, a 31% downside. They've rolled forward their estimates, but nonetheless a 31% downside from current market price.
Okay. Well, thanks. We'll watch out for both of these in the session today. Asian Paints as well as Tata Power, which had corrected a bit yesterday in trade. Now, mind you, like we said, the bigger focus is the index. And if you just look at what the election season has done for the markets, right? And just look at this chart that we prepared, which kind of shows the volatility around the election period for our markets. And it's been a very, very volatile Nifty, starting from April 19th, which was when the first phase 1 of the polling began, till as of 8th May, not 9th May, but the 8th May, 2:30 p.m. It was a loss of over 600 points. If you add the 9th May losses, it's even more. So, the election trade hasn't quite worked well thus far from a bull's perspective. Let's see if that were to continue. Avinash, if you had to accumulate something right now, 1 minute answer, what is it that you would do?
I think I would bet on the hospitality sector. I think we like companies like Indian Hotels, East India Hotels. I think these are, fairly defensive bets and with good earnings growth, potential possibilities for the coming year also. And I think, within the auto component space also, we like 1 or 2 companies like Sundaram Fasteners, Ask Automotives. These are companies which have been beaten down. And I think a good recovery in basically the two-wheeler markets is going to be something which would benefit Ask Auto quite significantly. In fact, Sundaram Fasteners would benefit from a large commercial vehicle and passenger car kind of volume growth expansion in the current year. So I think hotels would be a top pick, and I think Indian Hotels, East India Hotels, even at the current levels, an investor can expect a decent risk.
All right, last call, Amar, very quickly. What is the one big bet this morning on a very, very, I would say, iffy day where it's difficult to take a clear call?
Yeah, I would say that if one looks at a particular stock, in that case, Bharat Forge is one stock one can definitely keep a close watch on. Because this is one stock which has, I would say, defied the market's correction and continues to be very strong on the back of significant volumes and delivery quantity. And also what we're seeing is that the stock has breached a crucial zone of resistance earlier, which was around 1350 odd levels. So currently it's around 1400, 1420. If you look at the overall structure of the chart on the long-term, intermediate-term trend, short-term, that continues to be very strong. So this is one stock on any correction. This is a stock one can definitely look at buying. The levels to watch out for on the downside would be around 1350, 1360. If there's a correction towards that level, that can be a good buying opportunity with an upside target of 1470 on the upside, and stop loss would be below 1300 levels.
All right, gentlemen, we will leave it at that. Thanks so much for taking the time out and being with us and giving us your thoughts. Here's how the markets are starting off this Friday morning. Are we seeing stability, the signs of stability, or will that get sold into is the key question. For now, starting off flattish, but that green is welcome considering what happened at close yesterday, by the way. The Nifty Bank too, flattish in trade. Mid caps and small caps had corrected quite viciously yesterday. The small cap index was down 3%, and there's a bit of a bounce there for sure, about 0.5% higher for the small cap space. Let's pull up the heat map and show you what's moving on the index. Well, BPCL is the top gainer, but some of the PSUs which got rogered in trade yesterday are bouncing back. There is strength in NTPC, strength in Coal India, strength in ONGC. So certainly a bit of a bounce back. L&T is seeing a small bit of a pullback as well. So that too is welcome. But clearly BPCL is the top draw in the session. But the first four stocks are PSUs, by the way. Hindalco continues to rise, about 1% higher in today's session as well. Remember the Novelis IPO around the corner. SBI, after the 2% uptick yesterday, up another percent, so that's not doing too badly. But the reds are slowly mounting now. Britannia is the top loser, was down in trade yesterday too. Asian Paints another 1% down. Tata Consumer is down about 1%. IT is seeing a bit of a stick because Tech Mahindra, LTI and Infosys, all three of them are in the red, and HDFC Bank, which was down about 1.5% to 2%, is down another percent. So that's the clear big drag on the markets, and countering that, or trying to counter that likely, is the PSU pack led by BPCL, up now 5% in trade.
At least the initial sentiment a little more positive compared to the kind of drubbing we've seen. Let's just quickly pull up what's happening in the broader markets this morning and see if they're holding up as well. Not too bad, and all of this is of course relative to the last week, which has been a tough one. The Nifty small cap pretty much static over there. Let's start with what's not working and then we'll go to what's working. Intellect Design is one of your top losers on the broader markets this morning because of numbers more than anything else. Net profit down about 14%. That stock down 12% in opening trade. On the other hand, Quest Corp, their numbers seem to have enthused the market, about 1% up, come off its pre-open rates, but still holding up in positive territory. BPCL, HPCL, I'm looking at them together. BPCL, of course, the top gainer on the Nifty, but so is HPCL, not doing too badly. BPCL has a bonus share going for it, but overall crude prices also seem benign enough for an HPCL to have a pretty good morning. Paytm, because it's a second day where the stock has been in positive territory after a consistent drubbing. Remember, we talked about it in our trade setup as well. I just want to quickly pull up SRF and PNB. SRF has a clutch of brokerage notes which are fairly positive. The market really isn't to that extent. The counter completely flat, and Punjab National Bank, again, quite a few positive notes. Numbers were decent. Yesterday the stock was okay, but today remaining flat but in positive territory. A bit of a hunt today, Samina, to look at what's working. More losers with larger margins today.
Yeah, but it's actually not as bad as yesterday, and I think I'm going to take heart from that. Even though the last few days we had a positive start and then declined as we gone along, this morning a little better. So you've opened flat, we've actually built on those gains, and that's what we'll be taking a little bit of heart from. Broader markets doing better than the benchmark. The mid cap and small cap index is marginally higher. The Nifty is trading okay. 22,000 becomes a very important level that the street will be tracking. And also on Bank Nifty, 48,000 got taken out yesterday, so that is still on tender hooks. But in terms of movers and shakers, Jupiter Wagons, and I'm quite impressed by that up move in trade this morning as well. You've got another 5% being added to Jupiter Wagons. Their numbers were pretty impressive. They've going through a pretty sharp breakout after hitting a new 52-week high. The stock trades with a 5% gain this morning again. You've also got Manappuram Finance. It's rebounding after yesterday's fall. Take a look at some of the other ones. So you've got Endurance Tech, that's up 2%. 197 is not doing too badly. You've got BEML, Gujarat Minerals, GMDC trading with a marginal gain. So metals And our guest had also indicated that if you want to play, Aditya had very clearly said that if you want to play for a sweet rally today, you should be betting the house on metals. And that is one space that continues to look good in trade as we see it. Well, along with that, you've got some of those Adani Group names that continue to gain in today's trade. Tata Motors is having a pleasant morning ahead of its earnings. It had fallen all the way down to 980 only early this week, back at 1,042 on Tata Motors is what we have. You've also got TVS, Hero MotoCorp that are doing quite well in trade this morning. On the sell side, we've highlighted already that Intellect is having its roughs. You've also got a couple of those chemical names that are seeing some weakness. Tech as well in the broader market space is seeing a little bit of softness as we see it. Well, that's the market breadth. Now, whether or not we see some weekend cheer coming in for the street is what we should all be, or rather are hoping for. But Manish Sontalia, Chief Investment Officer at MK Investment, joins in with his view and perspective on the markets. Manish, good morning. Thank you very much for joining us. The last few days pretty much came out of nowhere. I mean, yesterday in particular, so the markets declined quite sharply. I know historically we've seen FIs who rather wait, buy at a premium after there's a conclusive event outcome as opposed to actually come in ahead of that. But as you see it right now, where do you think the biases sit? Do you feel like there could be some more buying coming in on the street, or it's going to be a little bit of a pause before some bit of gains return?
So I think the recent events over the last few days has been to do with liquidation of some hedge funds, India dedicated funds, which had to close down. And I think there was forced selling on account of liquidation of the assets that they had in the fund. I don't read too much into the fall apart from this. In addition, you have the regular volatility that comes along with any sort of elections. As the election passes through the phases, you start with high optimism, then it wanes in the middle, and then the likely scenario and the result starts to play out towards the end of the election. I think in India also, started with 400 seats for the BJP government, now NDA government, and then now fourth phase. You hear on the streets that even 272 is not coming, and then I would reckon that as you approach the seventh phase, you could settle somewhere between 330, 40, which gives you a majority on the government, policy continuity. You have a whole lot of money sitting on the sidelines waiting to get deployed in India, even if it means a 10% higher from the current level. So, I wouldn't believe that there's any reason to be simply bearish on India, because the season has played out, numbers have been okay, and I think sentiments also are quite reasonable.
Manish, I guess it's not just elections, right? So while you have elections on one hand, you've got earnings that have not done very much to enthuse the street. You've got the Fed that's got a delayed rate cut from the look of it. You have China that's making a little bit of a comeback. You have higher commodity prices, anticipation at least, which will eventually impact the input costs for a whole bunch of India. But let's not forget that investors have made money. At this juncture, what is the advice that you're giving out? Are you advising investors to sit on some dry powder, take some profits off the table, stay off adding additional money into the markets? What is the strategy? What should the strategy be? What percentage of the portfolio should be on cash?
I would believe that since we are towards the fag end of the elections, and in any case, medium-term outlook on India is quite positive. On the back of high teens earnings growth on the benchmark Nifty for the next 1-2 years at least, you have valuations which are not very expensive. Earnings season for Q4 began with a preview of around 5 to 6% YOY growth. If you leave aside the metals and the oil and gas pack, earnings are in line with around 15% sort of a growth, which is quite decent, I would believe. Yes, there is fear of some input inflation coming through, but that's going to work in favor of producers of commodities also. Pricing power is going to be important in that regard when it comes to users of the commodities. And as far as the Fed cut is concerned, yes, the cut didn't come about in March Then in the middle, you believe that there's not going to be any rate cut in this calendar year. And now the base case opinion is, no, there is going to be a rate cut this year, calendar year, and that rates in the US are not going to rise. All of these means that, as soon as the bout of cutting of rates for the Fed starts, emerging market as a whole starts to benefit. Of course, emerging market has seen outflows except for maybe a Turkey and a China, though they are seeing inflows, but there has been profit booking across the board. Emerging market flows have been negative. And India has also seen a bit of FII selling. But that has nothing to do too much with fundamentals. I would believe valuations are quite reasonable. If one is not too overtly worried about the next 5% correction on the downside, I think it is a buy on dip.
So, sorry, it's a buy on dip. So you should not be fully invested, Manish, at this stage. I'm a little confused. If it's a buy on dip, then I wait it out, right? No. I'd imagine, or stay fully invested.
Yeah, I mean, who worries about a 5% lower downtake on prices if you are positioned your portfolio for the next 2 to 3 years? I mean, it hardly makes a difference. So from that point of view, I'm fully deployed. And in any case, we are asking investors that if they can top up the current correction in the markets, and there's not been too much of a correction, so to speak. You had 22,600, 700 on the upside on the Nifty, and currently maybe you are at 22,000. So a 3.5% correction doesn't mean too much, but there is a lot of fear in the markets that the markets may have fallen a bit too much. But I would think that market positions are extremely light. There is apprehension on the results, which is keeping quite a few players away from the market. I wouldn't fear too much on a next 5%, even downside from current levels. In any case, if there is a top-up, we would advise investors to stay fully invested.
Manish, good morning. Niraj here. So the volatility and the reasons that you referred to has led to a fair degree of corrective moves. But I was seeing the list of the top 15 losers on the BSE 500, say. All of them have come off because of very idiosyncratic reasons, results or RBI moves, etc., so on and so forth. Do the regulatory changes, for example, on the NBFC side, worry you about investing in that space as actively as you were maybe, or are you constructive on that pocket?
So two spaces where there has been a lot of fear. One is the PSU basket as a whole. Of course, they have made humongous money for investors, but just look at the numbers that have been coming out of PSU banks in general, even public sector entities as a whole. I mean, those numbers are just too good for the valuation that they are trading at. I would reckon that there's a whole lot of upside on the PSU basket, the PSU banks as a whole. But yes, there has been a lot of selling on the higher side whenever they seem to move up. But I would believe it's clearly misplaced, so to speak. As far as the NBFC space is concerned, that this is going to impact infrastructure funding, power sector funding, etc. I mean, listening to a few of these power financiers calls, I mean, they believe that it is India's accounting, wouldn't impact the P&L, the profit and loss account at all. It's going to be taken away from the reserves. It's going to, at best, impact tier 1 capital of 2 to 3%. But in any case, they are sitting on a tier 1 capital of 23%. This is just a draft paper, so to speak. Whether it's going to impact the entire funding from the PSU banking side as a whole, I would believe that the apprehension is misplaced. In fact, this was to get implemented, it's only going to strengthen the risk management systems in the system. So, the size of the balance sheet of some of these NBFCs are going to be double at least between now and next 5 years. And of course, infrastructure, capital goods cycle, if one believes that it is going to puncture the capital goods cycle and the infra cycle in India, again, I would believe it's quite misplaced. So these are apprehensions. First of all, there is a draft paper applicable till 15th of June. Then there's going to be discussion on this. And then, how we heard the SBI chairman talk about yesterday that they are going to represent the PSU banking space concerns with the RBI on the draft implementation. So it's not a given. And in any case, if it gets implemented or gets diluted in its implementation, I don't think distorts the bigger picture of infrastructure creation and capital goods cycle coming back in a big way in India.
So actually, I was going to ask you a separate question, but my follow-up to my question is this, Manish. Power financiers, it's a small bucket, 3 names maybe, largely, which are dedicated here. The con calls seem to suggest some extremely strong targets on the book size, on the profitability as well. And I think there was one Economic Daily which was saying that the government may even revisit these draft guidelines too. My question is, they've run up quite a bit already, so the low-hanging juice is out of the way. Are they still good investment candidates, the power financiers?
100%. I mean, what valuations are we talking about? If we think that these financiers are expensive, we are talking about single-digit P multiples of 15%, at least a growth on the balance sheet, and a NIM, which is the best in class, north of 3%. And if you talk about the balance sheet and the leverage, the tier 1 capital stands at 23%. So the size of the balance sheet with the runway for growth is immense from where we are. So, we're talking about both of these financiers, the bigger ones, combined balance sheet size in excess of 20 lakh crores in the next 5 to 6 years. And REC today maybe have a loan book size of something like just about 5 lakh crores. So, Power Finance in any case is a holding company of REC. So all of them put together, the size is minuscule, the runway for growth is good. They can grow very aggressively, but I would believe if they have to grow judiciously, then they should be growing at 15% and, doubling the loan book in years, which is pretty decent. And the valuations are very attractive from the point of view of, compare it with the private sector names. And even so on the dividend yield side. So I believe they are clear buys as far as the valuation and the fundamentals are concerned.
Manish, hi, morning. Tamannna here, and I was listening to your initial comments on poll jitters and the number of seats expected, etc. I just want to understand why voter turnout is such an important factor for market participants. How does it matter? Beyond the point, how does it matter if instead of 400 seats, there are 300 or 320 seats? I'm just trying to understand the thought process, because you're going to have another phase on Monday. There might be another set of lower voter turnout numbers coming in. And will we then see a similar reaction?
Yeah, so if there's a continuity, then, people tend to take it lightly, plus the heat that is there across the country. The last time around in 2019, elections were in the month April, which was not that hot when you compare it with the current times. The elections are being held, let's say, the whole of May, and all parts of the country are pretty hot, so to speak. So that could be one of the reasons for the low turnout. And I think if there is a high turnout, which means that voters are enthusiastic for some sort of a change. But if there's continuity, it's just that they don't want to go and vote, things are fine and good. That could work against the current NDA government, is what the belief is. I'm not a great expert on politics, but believe that strongholds of the ruling NDA government, where there is a low voter turnout, could be a case of concern.
So, that's the thing about election season. Everyone becomes an expert on politics at this time. But nevertheless, the market makes its decision based on what it perceives. I'm wondering, Manish, that would you gear up for more volatility till, say, the 3rd of June, when your exit poll numbers would be out? What would be your call in that case? Stay on the sidelines till the dust clears?
Not at all. I would take advantage of the volatility to deploy as much as I can. In any case, if there is any top-up or new subscription, it gets deployed the first day. Because I clearly believe that, the policy direction in the creation of the new government, apart from, let's say, the budget jitters on the taxation front, and the roadmap is pretty clear as far as the earnings trajectory is concerned, the policy continuity. And I would bet on that side, the probability of the current government not coming to power is slim, even though the probability is there. And really, I don't side with the guys who believe that, yes, there has been such a great run-up in the markets that in any case, whoever comes to par, there's going to be a big fall in the market and give it a few percentage points. But again, once the markets have fallen, you have no other choice but to buy, because India is one of the highest growth countries in the world and you can't seem to ignore India. There's a lot of cash waiting on the sidelines. In any case, SIP money is pretty decent, and on top of that, if you have FI money come through, it's going to be a problem when it comes to quality stocks to buy. So if today it's available in plenty, I mean, best to lap it up.
Right, thank you very much, Manish. Great getting some perspective from you, especially at a time like this when there's a little bit of nervousness on the street and there's so many triggers that the street and participants are tracking. Thank you, and we'll hopefully see you soon, and you have a good weekend ahead.
Likewise. Thank you.
Thank you. Well, let's move on from there to Quest Corp. Let's pull up the stock. It's reported earnings that were highest ever in terms of top line. They've also managed to get their margins to 4%, which is what they'd set out for the company for FY24. Let's go across and find out what lies there in FY25 and what went behind this quarter as well. Kamal Pal, Hooda Group CFO, and Guru Prasad Srinivasan, ED and Group CEO at Quest Corp, joins in. Good morning, gentlemen. Thanks for joining in. It's been a good year for Quest Corp. I do remember you indicated last year that you'd strive for a 20% growth in FY24. What we've got is about 11%. But still, record numbers on top line. It's been a tough year, which we appreciate. Going into FY25, what is it looking like? Even the aspiration of a 4% margin in FY24 was pretty much achieved. Into FY25, margin improvement, revenue guidance, please share with us.
Sure. Thank you so much for having us on the show. Yes, our revenue growth has been 11%, but however, our EBITDA growth has been phenomenal. It's about 18% year on year. Our PAT has really grown 26% year on year. So many parameters that we had set for ourselves, we have achieved, whether it is the EBITDA margin. We started the year at 3.42% and it ended the year at almost about 3.92 with a blended average of 3.6. So I think, all the parameters that we had set for ourselves, whether it is operational efficiencies that we wanted to bring in, the sales growth and efficiencies that we wanted to bring in, plus the technology investments that we did to bring our cost to serve down. I think everything that has played well in terms of closing the year at a very high note, and we have ever achieved the highest ever EBITDA for Q4 and for the year as well. So we are quite delighted with the result what we have done for ourselves. And as we step into FY25, of course, two of our platforms, which is GTS, Global Technology Operations, and Operating Asset Maintenance, these two businesses are high margin businesses, high EBITDA margin businesses, and they continue to grow. We are having a good set of sales pipeline and funnel and order book for these two platforms. Plus our workforce, we are quite glad and happy to announce that we have crossed 400,000 by headcount in our workforce. And here on, of course, there are a few sectors which are going to be very augmenting this for FY25 for us, specifically manufacturing and BFSI and telecom. So we are seeing the demand coming in from these segments. So we are quite, I think we are entering into FY25 with a very strong foot.
Mr. Hooda, let me come to your profits which have gone up. There is an exceptional item, I think of about 20 crores this quarter. Can you tell us more about it? And has that sort of boosted at the end of the day the net profits as well?
So the exceptional profits in the current quarter is due to the divestment that we did for one of our businesses, QTG, which was into break fix business. But if you see on an overall basis, if you take aside any exception on a full year basis, also if you see the profit after tax has grown up to 280 crores and the EPS has gone to 18.6 rupees per share, both of them being in excess of 26% and 24% on a year-on-year basis.
What can you tell us about Foundit, formerly Monster, which you acquired? How long do you see the path to break even?
Yeah, so we had given guidance that Foundit should exit the financial year FY24 at a break even. Happy to share that the Q4 sales run rate for Foundit has crossed 50 crores on a quarterly basis. and it is very near to break even. The burn in Q4 for Founded was close to around 4 crores. The full year annual burn in Founded this year in FY24 was close to around 56 crores, down from 95 crores last year. And as we move into the next financial year, we hope on a full year basis we'll be able to get phenomenal growth in Founded, and we should be the burn that we did last year of around 56 crore, we should be able to bring it down to zero as we move into FY25.
Okay. Mr. Srinivasan, come in on how do you expect the different verticals to be like in times to come? Because while workforce management is still about 70% of your revenue share, one would believe that things like verticals like global technology services, etc., might do well over time. And I don't know if it's connected, but there is a lot of appetite of GCCs getting up in India in a big way. Does that become a big hiring trend for a company like yours?
It's a great question, and we are also working a lot, putting a lot of blocks together. So, for FY25 specifically, if I talk about workforce, we are getting into a more vertical-based approach. And it's important because each of our vertical, the large 3 verticals, we have 4 large verticals: BFSI, telecom, consumer durable, and manufacturing. So of this, at least 3 verticals, excluding BFSI, we already crossed 50,000 by headcount. And specifically manufacturing, we are almost about 70,000 by headcount. BFSI, we almost crossed about 120,000 by headcount. So what it needs is more focused approach. The solution or the hiring strategy or a platform is going to be very different than the other verticals. So we are getting more granular in terms of our execution. So we know the growth is going to come from each of these vertical at its, and they would be measured very independently. Similarly in IT, GCC focus, if you look at most of my mandates that we are currently delivering, almost 90% is from GCCs. So we have carved out a specific solution around GCCs to capture, and GCC currently employs almost about 1.6 million people, and we have more GCCs coming into the country, and we need a very specific approach. So for Quest, across this year is going to be more focus at a vertical level to create more solution and be closer to customers. That is something that we are focusing across. Whether it is a platform of GTS or whether it is platform of OAM, we are more focusing on vertical-based approach.
And what does this therefore mean for growth for you? Because when one looks from March 21 to 24, not double really, but you've grown about 75% on aggregate. Is there a target that you're setting for the next 3 years or the next 5 years for revenue growth?
So generally, we don't give a forward guidance.
No, not a formal guidance, but broadly.
Yeah, but if you look at Niraj, India is in its state of investment at the moment where it is. I'm sure once the elections are done, it will be much more firmer to see the way trajectory is going into. And we are seeing the investment coming into specifically in manufacturing and utility infrastructure, and all these are employment intensive industries, and we are directly linked to the economy in that space. So from that standpoint, at least 2 to 3 times of GDP growth should be our growth as well.
This is a great opportunity, Mr. Srinivasan, to also get your sense on trends. Now, when we saw the results coming in for the top IT companies, their net hiring year on year was down, and down by several, years. Are you seeing that trend continue, IT, ITES? What is the outlook there?
I would say yes, without any hesitation at the moment, because we are on forefront to receive the mandates, right? Yeah. So Q4 in itself, we have seen almost about 11,200 headcount coming down in IT sector, specifically IT services sector. And full year, on an annualized basis, almost close to about 70,000 people. Q1, we are still not seeing a great uptick, but however, I think the more mandates are coming in from GCCs, as I said earlier. We need a wait and watch for IT services sector to come back, and I'm sure when it comes back, it will come back really hard. So it's been most awaited.
So what are the sectors that are seeing positive mandates for hiring in that case? Because if ITES is looking slow, then that's not great news overall for the industry or for you. So where is the demand coming from?
So specifically in IT, it's largely from GCCs. Again, it cuts across every sector in terms of whether it is product, automobile, engineering, services. But when it comes to specifically to workforce, manufacturing, telecom, BFSI, and retail are 4 sectors which are contributing to the growth.
Right. You want to come in on this one too, Mr. Huda? I want to understand from you in terms of acquisitions and growth. Where is that growth and acquisitions going to come from? Are you looking at buying out companies? You've been on the spree recently, at least. And also, what does that mean for the debt on your books? I know you talked last year about how you wanted to actively work on reducing debt. Where does debt stand, and what are plans going ahead in terms of acquisitions?
Sure. Thank you for that question. So let me first answer the debt part. We had set a target for ourselves and happy to report that we've achieved that. So we could retire close to around 150 crores of debt in the last financial year, FY24. And the present debt levels, at a gross debt level, we are around 370 crores. Cumulatively in last 5 years, we have repaid close to around 700 crores of debt. So we are at a very comfortable levels of debt. In fact, we are a net cash company at a consolidated level. Our net cash stands at around 232 crores. So that's on the cash and the debt position. As far as acquisition is concerned, if you look at our history in last, I think 4 years, we've not done any acquisition. We are, the capital allocation policy has been announced. We're looking to focus only on our core business, and that has also led to we divesting some of our non-core businesses. We actually did a divestment last year, and again, in Q4 we completed a divestment for one of our businesses, which was QDG. And in Q1 we've just completed again a small divestment of division in Allsec, which is Co-Achieve, which is into the compliance business. So we're not looking for any active acquisitions right now. The intent is to focus on our core businesses. Like Guru said, a large part of our business is linked to the strength of the growth of the Indian economy. And with investments coming in infrastructure, real estate, utilities, and manufacturing, which are high employment intensive areas, we would love to grow our organic businesses with the growth of the economy.
Very quickly, Guru, do you think there's a good possibility of margins improving above 4%? You've made 4% this quarter, FY25. Does the range move upward?
Of course, all effort around that to see how few basis points we can go up. So I'm sure, I think we'll work towards that.
All right. Thank you so much. That was the top management of Quess. They've had a good year, but I think of the many things they've said to us, the takeaway that Q4 is still looking weak for ITES is also an important one. We'll take a very short break, but our conversation with management continues on the other side. We're speaking with Atul Kumar Goyal of Punjab National Bank about the quarter gone by. Stay tuned. right, it's result season and as we wind down towards the end of the quarterly numbers, one important set of numbers to look at is Punjab National Bank. Now, the PSU player has been a darling of the markets for most of this year and, has put out a fairly decent set of numbers. Atul Kumar Goyal is joining us. He's the MD and CEO. Mr. Goyal, thank you for speaking with us here at NDTV Profit. Let's just first begin by understanding the numbers. Now, the PAT looks very robust, up about 160%. Your operating profits have also moved up 9% year-on-year, 1% Q-on-Q. Net interest income is also up. But credit growth, while growing at about 12%, is slightly below target. What would be your take on the overall numbers and on credit growth?
Very good morning, Tamannna ji. As far as profitability is concerned, definitely there is an increase of more than 160% in the profit. The profit increases on account of the so many factors, but major factor is the contribution of the reduction in the credit cost. Credit cost for the last quarter has reduced to 0.80% and the credit cost for all over year was 1.40%. Since we have already improved our PCR to the 95%, so we are giving the guidance for the next year it will be below 1%. So profitability is bound to increase every quarter by quarter in the times to come. Your specific question regarding the credit growth, definitely it is little less whatever the guidance we have given, 12 to 13%. It was 11.4%. If you see the credit growth in the June quarter, September quarter and the December quarter, it was more than 13%. But YOY it has reduced on account of, because if you see the last quarter of the last financial year, March 23 quarter, there was some bulk business we have done. So this was the reason, and we are giving the guidance for the next financial year. The credit growth will remain within the range of the 11 to 12%.
And so 11 to 12% is your outlook for credit growth next financial year. What about deposit growth? Even that was slightly under the estimates that were given.
Yeah, deposit growth, we are giving the target around 9 to 10% for the current financial year 24-25. The reason was of the less of the deposit growth. If you see, my CD ratio is already around 71%. So there was no need for taking the bulk deposit. So we have resorted ourselves not to take any bulk deposit. Even as on date, we are having the excess SLR more than 1 lakh crore available to us. So this was the reason. Otherwise, if you see the CASA was 41.40%, and last year we have opened more than 1 crore saving bank account and 2.68 lakh current account where money will flow. So on account of this, we are targeting our CASA ratio should be around 42% in the current financial year.
I just want to come, to the point of recoveries. Recoveries have been robust. NPAs have also been coming down. But what is your outlook to the pace of recovery, sir?
Pace of recovery will remain very good in the current financial year also, because we are having around 90,000 crore rupees TW book and around 55 crore rupees of the gross NPA book. If you see the last year, our recovery was 3 times of the addition also. So 5.73 we have achieved for the gross NPA number, and the guidance for the current financial year is less than 5%. And similarly, the net NPA has been achieved to the range of 0.73%. The target of the net NPA is the less than 50% in the financial year 24-24. And since our PCR is improved to the 95%, so credit cost, as I told earlier also, we are giving the guidance less than 1%.
Okay. Goyalji, let me come to, I would say, the biggest topic right now for the banking space and for you as well, which is the RBI draft guidelines on project financing. Now, you have said publicly there's no need to panic, but there is a need for discipline in the space. Now, before I come to you and ask you, why you've said that, what do you mean? I want to understand what is the share of project financing, how much of this category is on the balance sheet right now?
My reply to this is the first is a draft guidelines. We should wait for the final guidelines also, because this guidelines has been issued by the regulator on the 3rd of May. It is like a consultative approach. and they have asked the comment from each and every stakeholder, whether it will be a bank and it will be a promoter side also or the corporate side also. So let us wait for the final guidelines. And one thing I can assure all of you, what will be the final guidelines? There shall not be any worry for the Punjab National Bank, because today our balance sheet is very strong. But some clarification is also required, because you are asking what will be the which type of the loan book you are having, because as per the draft guidelines, it is applicable to all type of the project finance in the infra as well as the non-infra without any limit also. So we will take the clarification whether there is a need of fix any limit etc. also. So I think there should not be a matter of worry. What will be the final guidelines? We should wait for them. We will be in a position to provide that.
Now, so what I want to understand is, as of today, as per the definitions in the guidelines, and I understand completely well these are not final, so with that caveat, as of today, how much of your loan mix will come under these categories, sir, of project financing, which would be subjected to higher provisions if these draft guidelines go through? So I've put all the ifs and buts, but having said that, how much of the loan book right now would be vulnerable to this?
That will not be too much of the impact, because some type of the loan in the loan book, the infra, where we have given the corporate loan, that will be the out of this purview, although it is coming under the category of the infra. Similarly, I would like to tell you also some of the discounting of the annuity from the NHI, although it will come in the book of the infra, but that will not come in under this guidelines. So in my opinion, rough estimate is like that, whatever our infra book is there, only 50% of that will be come under this category.
Well, a bit of an uptick for the markets, you have to admit today. There is strength, even though if you look at the Nifty 500, the advanced decline ratio is close to 3:2. So it's not that it's a runaway move, but the Nifty 50 is up about 0.7% at the highest point of the day. If you look at what's happened to individual stocks as well, it's decent. I mean, the top gainer is Endurance, which is up just 6%. So not that it's having a big move, but just that list of stocks which have gained. There's an Endurance which is up 6%, Jupiter Wagons is up 5.5%, Paytm is up another 4.6%. No big rara moves, but there's a bit of, a bit of a calm after the unease in trade yesterday. Yes, there are losers, as there always would be. And in today's session, it's no different. Intellect Design Arena, on account of the results and the downgrades that have come in, is down about 13% in trade. There is weakness in Birlasoft, KPIT, and a few other stocks as well, particularly the IT space. I don't know if it's got to do with what Intellect and some of the others have done, but there's a bit of a pullback there in the IT, ITES, and ER&D stocks. So that's to be kept in mind. PB Fintech is a bit of soft spot in the session today. So that's the other one that you have to keep in mind as well. But a clutch of names are doing okay too, and therein lies the point that save for Nifty IT, a lot of other indices have done reasonably okay. FMCG is, of course, ruling the roost, up about 1.35%.